Hi guys, welcome to this third session of CFA Level 2 Corporate Finance. Today we'll be covering the entire remaining portion of capital budgeting reading. So far we have done the basics of capital budgeting, the expansion projects, replacement projects, and then in the previous session we looked at some of the other theoretical stuff that was relevant for the capital budgeting. So today we'll be doing a little more of the remaining portions and we'll be wrapping up with our capital budgeting for corporate finance. So let's start with the first topic we have for today, which is talking about some real options in context of capital projects. So now from level one, you would probably have a small reference of options. So in the derivatives, we have options, we have call options, put options. Those kind of options can exist in all securities. For example, when we have bonds, we used to have something known as convertible bonds or puttable bonds, callable bonds. These are nothing but providing some sort of an option to either of the party to decide whether they want a particular payoff or not. So in capital projects also we have a situation where we can have options where the company or the management, maybe they are taking up a capital project for 5 years, but they are not sure if it would be profitable or not as of now, which can happen in the real world. For our questions, we'll always know what the future cash flows are, but in the real world, we can't judge them with a lot of certainty. So it can often create a situation where we might prefer as a management to have some exit options. Or maybe if the project works really good, I might want to infuse more capital. So I want enhancement options, something like that. So any sort of future contingency that would allow me to change the direction of my capital project. Those are known as real options. So let's look at them. So the topic for the day would be real options. So here we have five major categories of real options that are given in your syllabus. Now, before we get into details of this, I should let you guys know in advance that for options, the actual detail of how we value an option, the models that are used for option valuation, those are still part of your derivatives. So over here, we would be just looking at it from a slightly more theoretical perspective as to what an option brings when it is applied to a capital project. And we will also do a basic example to understand how the valuation of a capital project can be done without a value, without an option and with an option. So only the basic calculations are here. The detailed option valuation is still going to be part of your derivatives portion in CFA level 2. So for you, you have to understand what these five categories are, and then we'll be focusing on one equation that would be relevant for you. So let's look at the first one. The first is a timing option. So the first kind of options for capital projects that we have is timing options. Now, timing options have a one very peculiar feature about them, that they allow the management the freedom to decide when they want to make an investment, which means if the management thinks that right now is not the best opportunity for an investment, the investment has positive NPV, it would lead to profit for the company, but the management feels that maybe we can time the investment better. If we delayed the investment by a couple of years, it might be better. So all of those options in a capital project that allow the management to change the timing of the investment, maybe delay it, maybe expedite it, those are known as timing options. Then we have abandonment options. As the name suggests, these are the options that allow the management to abandon the project midway. So in certain situations, let's say a project is for 10 years, but within 2 years of actually into the project, the management realizes that no, it's not going to be profitable. The economic scenario is changing very rapidly, and maybe the project is not good. Instead of forcing the management to work for the next 8 years on a loss-making project, at times it might be beneficial to just abandon the project. So the option that allows the management to completely abandon the project in case it is making losses is known as abandonment. Now, abandonment can be thought of similar to how a put option works, the right to sell. So just like put option is the right to sell, abandonment option is giving the management the right to abandon the business, shut down the business. Then we have expansion options similar to call options. Call option was right to buy. Expansion is on the same lines, it is the right to expand. So if the management thinks that yes, the project is profitable and there is more investment that we can make, in that case, they have expansion options which allow them midway a capital project. So my project was for, let's say, 7 years. Within 3 years, I realized it is very profitable. I should expand further for the remaining 4 years. That is what expansion option is. Next up, you have flexibility. Flexibility options are primarily targeting the operational aspects. So let's say I set up a new company to manufacture cars. The general idea at the time of starting up would be that, okay, I'll have a scale of operations in mind, that I am trying to produce, let's say, 10,000 cars on an annual basis. But when I started the project, within 1 or 2 years, the demand was very high. So I think I might need a situation, I might need an option where I can scale up my operations. So I might need more labor, or maybe sometimes I might want overtime from my labor. I might want to overutilize my machines slightly, not to their breaking point, but at least to help me increase some of my production capacity. So any sort of operational flexibility that management might require, that comes from flexibility options. So these are options which allow the management to scale up and down the operational aspects of the business. Lastly, you have fundamental options. Fundamental options are not options as something separate, but these are inherent to the capital projects. There are certain capital projects, for example, I want to establish an oil rig. I found an oil reserve and I want to establish an oil rig to extract the oil from there. Now, the thing is, this entire process is a capital project by itself. But how much return or how much gains I'll have are dependent on the oil prices in the market. Now, the nature of this project is such that if the oil prices are low, I can just simply decide not to extract oil. If the oil prices are high, I can extract more oil. So option doesn't exist separately, rather it is embedded by way of nature of the capital project itself. Because my capital project was establishing an oil rig, by nature itself, it has an inherent option where it allows me to stop my production or to increase it depending on the pricing scenario that exists. So fundamental options are one that are embedded and inherent to the capital project itself. They are not necessarily separate options added on top of project, but rather they are existing due to the nature of the capital project. So these are the various types of options that you have in your syllabus. Now for the options, there is a very specific basic equation that has been given. So if I have a capital project that has any of these options embedded, so the NPV of a project with option, so I'm going to write with option, is denoted as NPV of a similar project with no option. So with option, no option. Think logically from level 1. Options, whoever was buying the long call or long put, he was getting a right, which means his losses were limited and he could reap additional benefits. The options give the long party the right to make a decision in the way that it is most favorable to the long party. As such, the idea is options always enhance the value to the long party. So whenever we have an option in a capital project, the idea here is simple. If I have a project which has an option with option, the value of a similar project, if that option did not exist, would always be lower. So I'm saying if the project has an option, its value would be at least equal to a situation where it didn't have option, plus whatever value addition is happening due to option. So in simple terms, let's say I want to manufacture cars for 5 years. If I looked at the NPV for 5 years, let's say it came out as 100 million. But I also know that automobile sector might expand. So in that case, I decided to have an expansion option also. Due to this expansion option, in reality, after 2 years, I might expand the business if the operations are really good. This creates a situation where I might have 20 million of addition. And together my option creates a total NPV of 120 million, which means if I look at a project that has an option, I can think of its value as being equal to a combination of project without option. Mind you, aside from option, everything is same between the two projects. So project without option plus how much value is being added due to having that option. Now, how exactly this is calculated, we'll figure that out. We'll do an example for that. One more key element is sometimes for the expansion or any sort of other options, you might also have to incur some cost. So think from derivatives. If you were buying the call option, you had to pay some premium. On similar value, you can have option cost. Maybe if I wanted to have an expansion option that I should be able to expand the business, infuse new capital after 2 years if I need. For that, I had to go to the bank, and initially I only needed, let's say, 40 million from the bank by way of loan. But because I also had an expansion option, I did an agreement with the bank that the credit line would be for 60 million, out of which I'll only take up 40 right now. And if I need it, I'll take that 20 million extra after 2 years. So in that situation, the bank would structure a deal as if the loan was for 60 million instead of 40 million. So there can be certain costs associated with having an option as well. So any of those costs would be here. So basically, project without option plus the benefit of option minus the cost of option. This is a simplified version of saying what would be the net benefit of having a project that has real options.